The biggest algo trading myth. Automated means emotionless. It sounds great, but it's not true. In algorithmic trading, emotions are still very present. They just show up differently than in discretionary trading. Many beginners imagine algo trading like this. Phase 1. I'll buy a cheap algo trading bot. Phase 2. I'll run it on my computer. Phase 3. Profit. The robot earns, and you take the day off, right? That's what the ads imply, an effortless equity curve for a few dollars. But that's not how it works.
Welcome to the world of algorithmic trading.
In this educational series, we explore whether it's possible to develop a robust trading strategy. Is it achievable? Let's find out together. Disclaimer: trading involves significant risk and may result in capital loss. This video is for educational and informational purposes only and does not constitute financial or investment advice.
Ask yourself, if someone had a strategy that reliably produced strong risk-adjusted returns month after month, why would they sell it to strangers for cheap? Real edges are scarce, and when they exist, they're protected, scaled carefully, or used inside a broader portfolio and risk framework. Algo trading isn't about flipping a switch and watching money pour in. Yes, computers execute rules consistently, but the strategy's edge can weaken. Market regimes change. Data assumptions break. Execution differs from backtests because of spreads, slippage, latency, or liquidity. And infrastructure can fail. VPS issues, disconnected brokers, rejected orders, wrong symbol settings. That's why serious algo trading requires process. You monitor that the system is running correctly, technically. You monitor that performance stays within expected bounds, statistically. And you intervene only based on predefined rules, not feelings. During these checks, you'll face reality, profit or loss. Imagine you see a drawdown starting to deepen. News hits the wires. Volatility jumps. Your brain immediately wants to do something. Take, for example, a robot that works with a distant stop loss and a mild form of increasing positions in a loss. With well-supported statistical settings, such a system will earn drop by drop over the long term and only rarely record a loss. That sounds great. The problem is psychology. For instance, one of the tested trading systems works with a risk of, say, $30,000. Let that be the capital you must have in your account. Monthly, it might earn $100 to $200 long-term, depending on volatility. During serious market shocks, however, it goes into an open loss of several $1,000s. And now it's your psyche's turn. Somewhere in the world, a war breaks out, or another serious problem arises, and the Forex pair begins its rapid journey against you. The loss in the open position is already minus $3,000. You know that the robot hasn't closed anything yet. You are just in a heavy drawdown. Two options stand before you. Option 1. The decline stops somewhere in the range of minus $6,000 to $7,000 for you. The market reverses, the robot records a small profit, and you trade happily on. Option 2. The direction of the Forex pair's movement does not stop, and your positions close with a loss of, for example, minus $10,000. It's Friday. The loss in the open position is already minus $3,600. You want to decide whether you trust the statistics and tests, that a truly large loss is possible, but usually doesn't happen. But if something goes wrong over the weekend, on Monday, it could wipe out your account in a few seconds. So what do? Do you let the robot trade normally and accept the risk that the loss could be truly large? Or can you not handle it psychologically and voluntarily close the trade manually at a smaller loss to prevent the risk of a possible larger loss? Say you are currently at minus $3,600. How will you decide? If you close it at a loss, it is common for the market to turn around in a few minutes, and your acceptance of a $4,000 loss was completely unnecessary. However, if you leave it open and the robot generates a loss of minus $10,000, You will blame yourself for not closing it when the loss was only 4,000. Even in algo trading, psychology can influence trading. In an ideal scenario, the following applies. Do not trade robots that trade in a way that is not acceptable to you. The example above is a good illustration. The robot risks an unsustainably high amount for the hope of a relatively small profit. Earning $100 a month and risking $10,000 is, for most of us, poorly set risk management. It also works the other way. It can happen that when checking systems, you find that your robots have open positions in an unexpectedly good trade. The profit is high, and that will tempt you to close the profit. After all, the market could turn, and the profit could turn into a loss. What do you do? If you turn it off manually, you may disrupt the logic of the tested strategy. So much for psychology in algo trading. Yes, robots trade for you and relieve you of pressure and stress. Unfortunately, not always. Automation doesn't eliminate emotions. It moves them to the highest impact decisions. Should I keep trading the system, pause it, reduce risk, or shut it down? An algo trader isn't someone who owns a bot. An algo trader is someone who defines rules and follows them, especially when it's uncomfortable. And here's the hard part. The challenge is rarely building a strategy. The challenge is believing in the process and letting it run through expected drawdowns without sabotaging it. At the same time, you must learn to distinguish between a loss that is normal variance within the expected distribution and evidence that the edge has degraded, structural change, parameter fragility, regime shift, execution mismatch, or broken assumptions. The system executes trades. The algo trader manages the system. If you decide to trade, only use an amount whose potential loss you can psychologically accept. You should not be losing sleep over what happens overnight. Try this thought experiment. Would you be comfortable taking $100,000 in cash and leaving it on a park bench? If the answer is no, then that amount doesn't belong in your trading account either. Now scale it down. If losing $100 would not change your life or your mood, that's the kind of risk level where algorithmic trading starts to make sense, using micro position sizing and a small, controlled exposure. If you have $130 a year from now, that's valuable progress. If you have $30, you'll be glad you didn't start bigger. And for beginners, a demo account is nothing to be ashamed of. It's often the cheapest way to gain experience without paying tuition to the market. Stick to this rule. The less experience you have, the less capital you should put at risk. Don't increase exposure out of impatience. Increase it only when you're confident of two things. You can handle letting the system run through drawdowns without panic decisions. The strategy has statistical evidence that it can recover over time. Some strategies die and never recover. In those cases, turning them off can be the right move, but that decision must be backed by data and predefined criteria, not fear. Algo trading isn't easy, but it can be professional, structured, and realistic. Thank you for your time. If you enjoy deep dives into real algorithmic systems, please subscribe. Trade well, and remember, trade edges, not hopes. See you soon.
If you enjoy the world of algorithmic trading, make sure to subscribe so you don't miss any upcoming videos.